Alright guys, in this video, I'm going to be teaching you the best ICT liquidity sweep trading strategy that you can use right now or in 2025 and beyond. This is the only liquidity sweep strategy you need. It is very easy and it uses 5 steps. So the number 1 step is bias. I'm going to teach you exactly how to find the correct bias so you don't get faked out. And the second step is basically using the daily candle open. The third one is a secret I'm going to tell you later on in the video. Fourth is, of course, the liquidity sweep. And fifth is secret as well. All I ask from return is hit the subscribe button. And I promise you, by the end of this video, you will have enough information to go and trade and make money in 2025 and beyond, right? So number 1 step, how do you actually identify the bias, right? So what we want to do is we want to use 2 time frames. So we'll be using 2 time frames. The number 1 time frame, the first time frame is the daily time frame, right? That's where we are going to be identifying our bias, right? And then we will be taking our entry on the 15-minute time frame, right? So let me just remove all of this and let me go here. This is NQ, right? So if I go to the daily time frame, I want to first show you how to identify the bias, right? So look over here. This is very simple and very easy, right? So we have a bullish candle here. The next bullish candle closed above it. So the third day is going to be bullish. So this is a 3 candle pattern. We have 1, 2, 3, right? We want to be trading the third candle, right? We want to determine our bias with these 2 candles over here, 1 and 2. What happened with these 2 candles? When this candle closed, the second day closed above it, right? So the third day, which is this, is going to be bullish. Right over here, you can also see that, let's say that this is the first candle, this is the second candle. So we see that the second candle right here closed above the previous candle high, right? So the bias for the third day, which is this, is going to be bullish, right? 1, 2, 3. We need 3 candles and we will be trading the third candle. That's where we're going to look for entry models and liquidity sweeps on this day to trade to the upside, because these 2 candles determined our bias, and to trade with the bias, we will be trading on the third day, right? Very simple. But I want to show you how accurate it is, right? So in this scenario, when you have a rejection like this, when the body doesn't close above or below it, in most cases, your bias is going to be this low. But in this scenario, it didn't work out. It kept pushing up. So we had a rejection, right? Body didn't close. In another scenario, I would target this low over here on the third day. I hope that makes sense, right? So for example, over here, we have this big bearish candle, right? And you can see that we had a rejection. We didn't close below it. If we did close below it, then on the third day, our bias would be bearish. But right here, you can see we had a wick and then we closed above it. Now our bias is going to be bullish until this high is taken out, right? But this is only bias. I'm not teaching you the entry model. I'm going to do that later on in the video, all right? That's the entire video. But right now, I'm teaching you how to identify your bias, right? So over here, you can see that whenever we close below the candle, so over here, we close below the third day. So this is 1 day, 2 day, and the third day. The third day is going to be bearish, right? Just look at it here. We have another closure, so this becomes 1, 2. The third day was bearish. Why? Because the second day closed below the low of the first day. So this is the first day, second day, the third day. We want to be trading the third day, right? We use the first and second or the previous 2 days for our reference, right? Very simple stuff, guys. It's not that complicated at all. So over here, you can see that we slightly closed above it, right? Slightly closed above it. So our bias was bullish and the first target could be this high over here. Then over here, you can see we have this bullish candle and price failed to close above it, right? We pushed up, but then we closed back around here. So our bias, what's going to be? What is it going to be? It's going to be bearish because we failed to close above it. We had a rejection to the downside. Our first target, of course, would be this low, and then we can target this low as well. And then from here onwards, you can see we close below this low, right? The third day is bearish. Now, in this scenario, when you don't have a closure or a wick, right, you avoid that day. Very simple. But over here, you can see we failed to close above this bullish candle and the third day. So this is the first day, second day, and the third day. We had a wick to the upside. We failed to close above it. So the third day was bearish, right? We want to get our entry inside this wick of the third day, right? Because at the end of the day, what I'm teaching you is power of three. We have accumulation, manipulation, and then distribution to the upside, right? So you can also see over here, we close above it, right? The third day was bullish. Look at it here. We close above it. The next day, the third day, bullish, right? Look at it here. We close above it, close above this high. The third day, which is this, is bullish, right? And then we reach this point where we have a reaction, right? And then the next day, the third day was bearish. Overall, you can see that we would have been, since this was bearish, we would have taken our entry around this level, inside this wick. So very, very simple stuff, guys. I'm going to give you guys something. Now, of course, it's not going to be accurate 100% of the time, but you can see how accurate this is. For example, I'm going to give you one last example. We have a rejection here. We didn't close below this, right? But then on the third day, you can see we pushed up and we took out this high over here. So this was a bullish day. So we would have taken our entry somewhere around here, right? Very simple stuff, guys. And you can see over here, when we close, the third day is bullish. Close, oops, right? We close above, third day is bullish. Then we have what? A rejection. We failed to close below this candle or above. So when you get a rejection, the bias is going to be bullish over here, right? It's very simple stuff. Very mechanical way to find your bias, right? You can see how well it works. So first off, what we do is we identify our bias, right? If our bias is bullish, right, what we want to do is then we want to drop down to the 15-minute time frame, and then we want to mark out the opening price of the third day, right, as I explained. So this is going to be the opening price of the third day, right? Very important. When you have the opening price, right, so let's just do this, right? Our bias is bullish. Remember that. So we have price pushing up, right? And what I want to see, this is getting a little messy, but I'm going to do it. All right. So just to the left of the opening price, if our bias is bullish, we want to mark out the most recent liquidity level. And this is the sell side liquidity. When our bias is bullish, we want to look for opposing side liquidity to be swept, right? And then we can take our entries. So this is all happening on the 15-minute time frame, right? 1-5, remember that. So we have the opening price, right? What I'm expecting if we are bullish, our bias is bullish, I'm waiting for price to sweep the liquidity to the left of the opening price, right? This is the opening price of the third day candle. Look to the left side. We have this sell side, right? I'm not looking at the future price action or the present price action. I'm looking at the one that was engineered before the opening price. This is the opening price. Look to the left. We have sell side liquidity over here. Then we get a sweep. We look for a market structure shift. We take our entry from the auto block or a fair value gap, and we write the bullish move to the upside. Very simple stuff. It's not that complicated, right? Now, let me show you that. Let's suppose that we have, let's say we have our bias as bearish, right? Our bias is bearish. So you would do the exact same thing. You mark out the opening price of the third day, right? This is the opening price. So let's say you have price action here on the 50-minute time frame, but then you have something like, I don't know, this, right? You have this liquidity pool just to the left side of the opening price. So what I'm expecting is price to push up, take out the most recent liquidity that was engineered before the opening price. So this is high over here. Since our bias is bearish, we want to look for the opposing side liquidity sweep, right? So we want to look for buy side liquidity sweep. That happens right here on the 50-minute time frame. And then afterwards, what I'm simply doing is I'm basically just looking for a market structure shift, right? and then I'm taking the move to the downside. So the move to the downside will primarily and usually happen after the 9:30 open, right? So you get the highest probability distributions to the downside after the 9:30 open. So now that I've given you some examples on how to identify your bias and stuff, let me show you guys some examples, and then I'll end the video. Right, so here is example 1, and we're going to be studying these 3 candles, 1, 2, 3. The third day is when we are going to take our trade, but we're going to use the first 2 candles or the previous 2 days candles to determine our bias. So you can see that the second day candle closed above the first candle's high. So our bias for the third day is going to be bullish. So we simply mark out the opening price of the third day, and then we look at the 50-minute time frame and we identify liquidity levels, right? So this is the opening price. Look to the left side, which is the most prominent liquidity level, right? So our bias is bullish, so we want to look for sweep of sell side liquidity over here, right? We want to look for opposing side liquidity sweep. So right here, this is the opening price. Price dips below the opening price, gives us accumulation, manipulation, right? And then we have a market structure shift right here with a fair value gap just around this level. And then you can see we took our entry and price went up right away. Very simple stuff. Very, very simple stuff. Let me give you guys another example. All right, so now we are going to be studying these 3 candles. So 1, 2, 3. Over here, you can see we failed to close above this bullish candle, right? So when we have a rejection, the body closes below the high of this candle, right? Now, for the next day, our bias is going to be bearish towards this low over here. That is our bias, not our take profit level. So remember that. So we are going to be taking our entry inside this third candle, right? So let's go down to a lower time frame and see what happens. So I've marked out the opening price of this candle. Right. So this right here is the opening price. And right around this level, you can see we have these relative equal highs, right? Just near each other. So opening price, we have a Judas to the upside. Our bias is bearish. So we look for opposing side liquidity sweep. That happens right there, right? And then afterwards, what you can see, we have a market structure shift, right? And then we have this tiny bit of fair value gap that we can use to take our entry from. Or there is an auto block over here that you could have used to take your entry, right? So this would have been your entry, stop right above the high. And you can see I usually go for 1 to 2 risk reward, but you could have targeted, this inefficiency right here, right? This could have been a good target. Now price did come back up again, swept this high over here, but since our bias was bearish, we dropped down once again, right? So usually I go for 1 to 2 or 1 to 3 for these setups because I don't want to hold my trades for any longer than 1 to 2 or 1 to 3. I make my money and then I move on to the next day. So let me give you guys one more example. All right, in this example, I'm going to be studying these 3 candles, 1, 2, and 3. We will be taking our trade inside the third day around here, but you can see we used the previous 2 days candles to determine our bias. So we closed above the first candle high. So this is the closure. On the third day, that's when we're going to take our entry. Our bias is bullish. So we want to look for opposing side liquidity sweep, right? So I'm going to mark out the opening price of the third day. That's when we're going to look for trades. So going back to the 50-minute time frame, you can see that we have the opening price of the third day. And to the left of it, we have sell side liquidity around here. So we have this, and we also have this, right? So we have a Judas to the downside. Then we look for a market structure shift. Happens right there. And then we have this auto block, right? It doesn't get any mechanical than this, to be very honest with you. You can use this, to make consistent profits, right? And you can see how big the distribution was to the upside, right? Now, of course, it's not going to work every single time, but I promise you, this is literally all you need for 2025 if you are looking for an easy strategy that uses liquidity sweeps. That's pretty much it for this video. I do recommend that you watch my other videos as well. You're going to get more knowledge if you are a new viewer or subscriber. just go and watch my old videos, right? And that would be it. Thank you guys so much for watching.